capitalism is being revolutionized by this change, and it indeed is. The impacts on all the metals are going to be huge.
The increasing sort of electrification of the power systems around the world, the energy systems around the world, is likely to benefit a lot of these key metals.
So I think the current spate of high prices, the longer it lasts, the worse it actually becomes for fossil fuels. And conversely, the better it then becomes for the metals that are going to be needed for renewable technologies.
Good morning, everyone, and I'd like to thank you all for joining on this Commodities Outlook webinar hosted by One-to-One Mining Investment APAC Online. This is the first of our webinars for the APAC session event, which is going to be taking place on the 2nd to the 4th of November. If you haven't started signing up for your meetings, I believe the meeting planner is now open. Definitely feel free to get in touch with me or my team if you need any assistance on that front. So joining us today for this Commodities Outlook webinar, we have Warren Gilman, Chairman, CEO, and Director at Queen's Road Capital. We have Daniel Hines, Senior Commodity Strategist at ANZ, and Clyde Russell, Asia Commodities and Energy Columnist at Thomson Reuters. So thanks everyone for taking part today. And so I just want to let the audience know that we will be taking questions throughout the webinar. There is a Q&A box at the bottom of the screen, so definitely feel free to put in any questions that you might have for our panelists at any time, and we'll be sure to kind of take the questions throughout the webinar. So to kick things off, I thought we should start the discussion with a look at what's happening with the global supply chain. So they are quite strained right now, and this is certainly impacting the supply of raw materials to the markets and it's bringing costs higher. What are some of the impacts that you're seeing on the metals and mining industry? And do you see any resolution to these disruptions anytime soon? So perhaps Daniel, if you'd like to kick us off there.
Yeah, look, I mean, it's interesting. This cycle, we've seen, as opposed to previous ones, an increasing sort of supply side dynamic around the rally in prices, and this is, we think, reminiscent of some previous rallies in commodity prices many decades ago, where it wasn't just strong economic growth that boosted some prices, but it was obviously the combination of that with the supply side issues. And at the moment we're seeing a whole host of issues really impact the entire supply chain. I mean, when you look at some of the commodity specific sort of markets like the metals, we're seeing an increasing sort of impact on the energy crunch and power shortages in a lot of countries, really impacting supply. So particularly in China, where a lot of the metals tend to be processed into refined products these days, where we're obviously seeing authorities there restrict power to smelters and refineries, and that's resulting in disruptions to output on a sort of a periodic basis. But the impact, the subsequent impact that is having on costs could be just as great. I mean, we are seeing for the first time a huge increase in electricity prices in China, and obviously tending to be sort of focused on the areas where these producers are, and as a result, their production costs are starting to rise. Certainly for some aluminium producers, for example, which have been used to fairly consistent, fairly flat sort of electricity costs as a result of that smelting, that they're now seeing this big increase in costs. And to add on top of that, we're starting to see, rising carbon prices have an impact. And I, noticed just the last week or two in Europe, we've seen a couple of producers such as Nearstar talk about, the rising cost of carbon prices impacting production costs. And in fact, they reduced output at their European smelters quite significantly, blaming the rising carbon costs as an issue for the market. So these supply side issues are certainly starting to ratchet up quite significant, purely as a result of the power crisis. And I think it's obviously something which the market has been increasingly focusing on recent times, but it's certainly been something which has been bubbling away for a couple of quarters now, but clearly is starting to have an impact on actual output for a lot of these commodities.
And Clyde, to bring you in here, what are you seeing?
Well, similar to Daniel, I see quite a lot of disruptions, mainly from the energy issues that we're having in Asia and Europe. I think you've got to separate a little bit about how much of this is a supply chain problem and how much of it is self-created by various countries. So the way I look at it is, if you look at ores, so iron ore, copper ore, those kind of things, there's not really a problem with supply of those at the moment. And that's perhaps why the iron ore price has actually been coming off quite a lot. There's enough iron ore to go around to meet current demand. Where you're seeing problems is in the refining of metals, particularly in China. So all those kind of energy intensive ones, particularly aluminium, and to a lesser extent, copper, zinc, manganese, all of them, they're being asked to cut back on their output or their energy consumption. Now, why is this the case? Well, China's electricity demand has risen quite dramatically this year, something like up 14% in the first 9 months. And they haven't really been prepared for that, quite frankly. They scored a bit of an own goal with shutting coal mines for safety inspections and for a bunch of other reasons. They also banned Australian imports of coal. Now, that in itself was not a huge volume of coal, but Australia was their second biggest supplier. And suddenly they tightened their own coal market voluntarily. This is not something they did, that's something that happened unexpectedly to them. This was deliberate Chinese policy. And then they were caught short of power. So they've actually had to scramble to try and increase coal production in order to feed their thermal plants. The thing that I look at is, when you have a supply-led rally in prices, as in coal, as in natural gas in Europe and LNG in Asia, what tends to happen is, as soon as those supply issues get resolved, then the rally tends to dissipate and collapse. So you saw it earlier this year with iron ore. It went to that ridiculous price of $235 a ton on the spot market. That was clearly unsustainable, and it was just a completely ridiculously heavy, frothy outcome. But it did have a fundamental driver in that the supply from Australia was tight because of weather-related disruptions earlier in the first quarter. Supply from number 2 exporter, Brazil, was also tight. They were struggling to get their output up because of coronavirus-related issues. So you had these sort of genuine reasons why there was a supply-led rally. It just got too frothy. And I think the same thing's happening in coal. I think the same thing's happening in LNG. There are fundamental justifiers for higher prices, but not to the current levels. So I tend to look at it from that point of view of, yes, there are problems, but I work on the assumption that eventually the Chinese will produce more coal. Eventually, India will get over its kind of COVID problems as well, and it will produce more coal. And those two sort of major coal miners and consumers, and that's their main source of power still. Once that happens, you'll start to see the price pressures come off in a whole range of things. But that might take several months. I mean, I don't expect this to happen before the end of the northern winter, for example.
Yeah, and sort of following on from Clyde, I mean, I completely agree on the supply side dynamics. They can quickly fade and have quite a big impact on prices. Although, I get a sense that it might not just be short-term issues which are impacting the output of metals. I get a sense that a lot of producers are taking a more pragmatic, cautious approach to this cycle, considering, I suppose, that the potential long-term headwinds around demand. And we are seeing a lot of major diversified companies tend to give back capital to investors, increasing dividends and share buybacks and the like, rather than ploughing a lot of that capital back into their businesses. They're clearly still trying to debottleneck the system and improve their current operations, but in a lot of cases, we're finding that new greenfield capacity or investment in new greenfield capacity is relatively subdued compared to previous cycles. So, we may get these issues around power shortages really impacting supply quite significantly in the shorter term, but I'm not too worried about a huge wave of supply then subsequently coming back onto the market with the high prices. They're taking sort of like the OPEC's recent sort of strategy to heart, I think, for a lot of metal producers, where they're happy to take lower volumes with higher prices at the moment, until I suppose there's strong evidence of a sustained sort of pickup in demand. And certainly in markets which are going to be critical to some of these new energy sectors, like copper and nickel and the like, I think they're pretty keen to put money into the ground. But I find in a lot of cases that growth in new capital, new investment is actually relatively low compared to sort of previous cycles.
Okay. And Warren, did you want to jump in here with your views?
Yeah, thanks, Amy. A couple of comments. Certainly this is a topical question because it's what we're seeing in the markets at the moment. It shouldn't come as a surprise to anyone because we've got supply chain issues around the globe in virtually every industry. So mining is no exception, and it's interesting that it's sort of being recognized now. It's a bit of a delayed reaction, really. But the most important point, I think, is the one that Clyde made, which is that whenever you have a supply-induced run up in prices, it tends to be shorter term in nature. Longer term impacts on metal prices are virtually always demand led. And ironically, all of these problems are related to or have an impact on a negative impact on demand. So ironically, if you're a miner and you're looking at delivering X amount of tons of zinc con and your refinery has shut down because of lack of power, they can't take your zinc con. So if you're a miner, you're not benefiting and you're having trouble selling your product. So that's being reflected somewhat in the markets. And you can see that even though prices are back to where we were a couple of months ago, copper equities are not anywhere near the highs where they were a couple of months ago. Zinc stocks, zinc equities have moved a little bit, but nowhere near what you'd expect them to move in terms of the actual price of, quote unquote, the price of zinc. So, when I look at this from an equity perspective, it's a great time to be taking profits in zinc companies because I'm getting a short-term supply-induced spike. I'm getting some volumes in stocks that weren't there before at a higher price. So frankly, it's probably a rally that you sell into and then wait for these supply constraints to be solved and then buy back in. And, although I agree with Clyde's comment that it won't be, quote unquote, solved until the end of the northern winter, markets always anticipate the solution a few months ahead And so, I would expect that this rally peters out before Christmas, and you'll want to have executed any trades that you want to execute based on this rally.
Okay. So you're bringing up kind of this idea of demand as really being one of the key drivers. So moving on to kind of a slightly different topic, looking at the global energy transition. The demand for kind of some of the key metals and minerals involved, such as lithium, cobalt, nickel, copper, analysts are saying that the supply is not going to be enough to meet demand. So what are some of the impacts, I suppose, on pricing that you're seeing? Do you see the supply coming up in some of these key metals, or where do you see the supply not really being able to meet demand, and maybe alternatives maybe needing to come into play? Clyde, maybe you want to start us off here.
Well, this is kind of a difficult one to actually get a handle on, because right now in the here where we are at this moment and for the next couple of months, there's not really what you would say shortages of lithium or cobalt or nickel or any of those kind of so-called new energy metals. What you're really talking about is, in 3-4 years' time, will we have enough? And I've learned that sort of debate is really, really hard. And thank God no one ever really goes back and looks at what I said 3 years ago, because it's very hard to get that right. If you're looking at a longer term trend, if the electrification of particularly vehicles continues to be a big thing, and I look at what's happening in China, and they're getting some very impressive numbers on electric vehicle sales, and let's assume that spreads to other key markets like North America, what you would actually then be, you would actually be short of lithium, cobalt, and possibly nickel as well, not to mention copper. There hasn't been a lot of major copper mines being brought online in the last few years, just a handful, and we've seen the grades in Chile are at the big mines there are progressively getting lower. So you could end up in a few years' time short of copper and lithium and all the rest of them. The question is, are people right now today prepared to put money to build things on the hope that this is actually what happens? And I think Daniel got it right when he said there's a lot more discipline amongst the mining companies now than there was. I think everybody remembers and is still scarred from that period from about 2012 to 2016, 17, when prices just kept falling and falling at the same time as they were all ramping up production massively. So, that was a life-altering experience for many of today's current crop of CEOs at mining companies. So they're going to be very, very disciplined about it. So it's that old sort of thing, discipline now on spending and investment will create shortages later, and then there will be a massive scramble to meet them. Yes, I still think it's a problem for another day, but the main issue with that is I think people are just kicking the can down the road. And as we all know, eventually the can hits something and it can't go any further. So not a problem now, but definitely a potential issue for a few years' time, because mines can't be built quickly. And while there are some projects that are looking ready to go, they've proven their reserves and things like that, it still takes quite a lot of time and quite a lot of effort to bring those on.
From what I've heard, the investment is there in this space. It's a matter of, as you said, timing and I suppose finding the right resource.
Yeah, it is all a timing issue. I mean, right now, there is quite a lot of capital still available. At least that's what I'm told. I mean, Warren would probably have a much better idea on that than I would. It's just getting it committed to actually, building mines, putting holes in the ground, and getting things going. That seems to me to be more of a trouble. There seems to be a lot of activity around, sort of exploration and proving things up and that kind of stuff, and not so much activity in actually physically building mines.
Warren, maybe we can bring you in here to talk about, is the money there, and what are you seeing?
Yeah, well, first of all, Amy, on your original question, and the impacts of the change that's going on in the world, I mean, that is such a huge question. The world is changing. You know, I heard a phrase the other day that capitalism is being revolutionized by this change, and it indeed is. The impacts on all the metals are going to be huge, and it gets back to the point we made earlier about supply versus the impact of supply disruptions on price being relatively short term versus demand being a long-term impact on price. And the demand impact of energy transition on the mining world is a long-term fundamental impact that is absolutely staggering in its immensity and is still underappreciated by the market. So we can come back and talk about individual metals and individual commodities within that context, but generally speaking, it's going to be massive and is still underappreciated. Now, getting back to the question of capital, sorry, someone at my front door. The mining industry is notoriously always overcapitalized. It's been one of the fundamental problems with its industry going back for 50 years. We've got way too much money chasing poorer quality projects. And when you have a price boom, as we've had for the last, well, it's going on to almost 18 months now. Obviously, equity markets are on a tear, and companies' cost to capital and access to capital is at unprecedentedly, the cost of capital is at a low level and access is at an incredibly high level. In addition to that, you've got, you know, traditional banks who are still there and probably reinvigorated now for the green side of that financing equation. You see some banks actually starting up whole new departments to finance green energy projects. So some aspects of our industry are very much in demand again from mainland banks. And then private equity is raising money at unprecedented levels, billions and billions of dollars. Unfortunately, that all translates into two things. One, relatively poor return for all of that invested capital as it looks to get a home. And I can expand on that one in a moment. And secondly, projects that shouldn't necessarily get built. So the problem is certainly not finding money to build mines. The problem is actually, in a lot of cases, building mines that never, ever should be built. Now, some of those things will get skated on side in the course of the next 10 years, simply because of the point I made earlier about unprecedented levels of demand, and that's going to lead to higher prices. But some mistakes will be made along the way. I mean, the mining industry is absurdly difficult. You have tremendous technical challenges. On top of that, you have an industry that is highly volatile and highly cyclical. And on top of that, you often place these projects in parts of the world where your geopolitical risk is immense. You require lots of money for long periods of time. And frankly, you don't even know if you'll own that project 3 or 4 or 5 years. And by own it, I mean either through tenure or title or through overt taxation. So if I was to come to you and say, would you give money to me to build a mine? You'd say, well, I've got technical issues, I've got cyclicality issues, I've got geopolitical issues. Throw all that into the mix, and heck, do I want a discount rate? You know, mining projects around the world, you know, gold projects have a discount rate of 5. A mining project in Canada has a discount rate of 8. You go outside of Canada and Australia, you get a discount rate of 10. Are those rates of return that compensate you for that incredible 3-tiered level of risk? Of course not. It's absurdly low. And that is a reflection of the overabundance of capital.
Just circling back to the original point on energy transition and impact on demand. I mean, I'm certainly starting to see, you know, an impact of that, you know, start to really boost demand. I mean, clearly China's always a case in point there, but I think, you know, the increasing sort of electrification of the power systems around the world, the energy systems around the world, is likely to benefit, you know, a lot of these key metals. I mean, when you look at China, for example, you know, Clyde talked about the increasing sort of sales of EVs there. That's only going to put additional pressure on the power grids there. You're seeing the movement of heating, in particular, go from, you know, the direct burning of fossil fuels in that country to the grid, to the power grid as well, and that's why we're seeing, you know, growth in energy consumption up double-digit rates, whereas GDP growth has been quite subdued, and we saw obviously the number come out yesterday. So we're seeing this additional increase in demand on electricity, driven by this real need to hook into the renewable energy sector, and I think, you know, that's going to power growth in demand in a lot of key metals. I mean, copper stands out as one of the key ones there, being both a beneficiary of you know, investment into power grids and power lines and the like as well, but also you know, that continued sort of investment into the renewable energy sector, where, you know, we see the you know, the copper intensity of use per gigawatt of capacity, you know, multiple times, you know, 8, 9, 10 times the amount as you would see sort of in coal-fired power generation. So, you know, that movement to a more electrified economy, particularly in developing markets, emerging markets, you know, like in Asia, is going to see, you know, some of these metals benefit quite significantly.
I also think an interesting point to make is the current high prices for natural gas and coal. A lot of your sort of fossil fuel proponents, and believe me, we have a lot in Australia, say that this means that we should invest more in fossil fuels. We should build more coal mines. We should do more LNG plants. We should do all those kind of things. I mean, that is a potential solution. I'm not going to talk about the politics of this, but I think it's more likely, when you actually look at what the trend in the world is, that it will have the opposite effect, and it will lead to demand destruction for fossil fuels. Because the way I look at it, if you were, say, a utility in Bangladesh, and you are wanting to add a gigawatt of power to your generating capacity, and effectively you've got 3 ways of doing that in Asia at the moment. You can run a coal plant based on imported coal, an LNG plant or gas plant based on imported LNG, or you can build renewables backed by battery storage. Now, cost-wise, renewables would still appear to be the cheapest of those 3 options on the capital basis. But then if you throw in the operating costs of fossil fuel plants, they become vastly uncompetitive. And that's even before you look at the potential of carbon taxes, carbon border taxes, those kind of things. So if you're sitting looking at building out electricity capacity virtually anywhere in Asia, you're going to be looking at you know, renewables and all the metals that they come with far more favorably now than you were even 3-4 months ago, because believe me, a thermal coal price of $250 a ton for Newcastle supplies, and almost $40 per MMBTU for LNG. I know those are spot prices, not contract prices, but those are going to really, really hurt anybody thinking of investing into buying or setting up those kind of fuels. And as far as I can see, particularly in India, they're going to run away from fossil fuels as fast as they possibly can because it's just too expensive. And quite frankly, in the last few years, they've become too volatile as well. Yes, there was a massive plunge in prices last year, but if you actually look at the price graphs for the last few years, both LNG and thermal coal have been pretty, up and down all like this all the time. And that is the sort of thing that companies that plan for the long term, like utilities, they really just don't want to see that. So I think, the current spate of high prices, the longer it lasts, the worse it actually becomes for fossil fuels. And conversely, the better it then becomes for the metals that are going to be needed for renewable technologies.
Do you actually see this happening in these parts of Asia where coal is being passed over for more renewable sources?
Well, there is data available on this. There's a wonderful group called the Global Energy Monitor who actually track every coal-fired power plant operating, being built, or being planned in the world. And what you're starting to see is, at the moment, right up until now, to 2020, or at least last year, the amount of coal capacity being added to the world was still more than the amount of coal capacity leaving through coal retirements. That's probably going to flip, not this year, but maybe the year after, where the amount of coal plants being retired exceeds the amount of new coal being added. But what you can see quite dramatically is the amount of plants in the sort of planning and permitting phase is just plunging. And the amount under construction is actually falling as well. And if you took China away from the amount of coal being constructed, it's really slows to a trickle. So it's basically 3 countries in the world are building the vast majority of the coal-fired power plants. There's China so far ahead of everybody else. They're building more than half of the current coal plants under construction. And then you've got India and Indonesia. Now, the big thing in common with all those 3 countries is they have vast domestic coal reserves and resources. So they are tempted to keep using them as much as they can because they can do it cheaply. But if you look at imported coal, countries that will be relying on that, they've been abandoning coal at a very quick pace. Pakistan, Bangladesh, these are not countries they're walking away from it. Not only because of the price issues, they can't get financing now anyway. And if China does actually hold to its president's commitment that it won't finance any overseas coal plants from now on, I mean, that's basically the death knell for coal built on imported supplies.
Okay. So I suppose looking further at the energy transition and various metals and minerals, we do have a question from the audience asking, going forward, what is your view on the role of nuclear power in solving the energy mix for decarbonization and climate change? Maybe Warren, if you want to kind of kick us off on this one.
Well, I think everyone knows my answer to that one. I'm a little bit biased in this regard, as people know. I mean, I've been a big investor in the uranium sector ever since our first big investment with Li Ka-shing in Next Gen Energy back in 2016. So I've been putting a lot of money into the space for the last 5 years. And the company that I'm chairman and CEO of, Queens Road Capital, probably about 80% of our NAV is currently in the uranium space. It didn't really start out that way, but the way that our investments have performed, we've become heavily dominant in uranium, a victim of success in some regards. But obviously, speaking from an obviously biased perspective, but I think it's still a sound view, and that is that nuclear will play a key role in the energy transition. Not only is it a key role, it's a pivotal role. It's something that the world simply has to have. thought leaders around the world seem to have gotten on side with this view over the course of the past year. You see the likes of Bill Gates and Elon Musk, and people who drive opinions in the Twitter sphere coming on side and being supporters of nuclear, whereas as recently as 2 or 3 years ago, you probably would have had a less welcoming reception. You now have bipartisan support in the US for the first time in 50 years regarding the role of nuclear energy in the United States power mix going forward. You're starting to see it in Europe, and you're starting to see countries like Germany realize perhaps we've made a mistake by shutting down nuclear plants too early, because how are we replacing that energy demand? You see countries like France recommitting to nuclear energy. So from everyone from individual retail investors right up through countries around the world, I think you've seen a sea change in the perception of the role of nuclear when it's included in the European taxonomy in the coming months. That will be, again, another game changer in terms of recognizing the pivotal role that nuclear is going to play in the world's energy transition in the next 50 years. And the impact on the uranium mining industry is going to be incredible. That's my perspective.
I mean, I agree with Warren. It's got to play an absolutely critical role. And when you look on the face of it, it's a perfect energy source for the new world. But I do still worry about, I suppose, the opposition on some of those from some of those areas where it hasn't been a huge part of the energy mix before. I still get a sense the political conversation is still a little bit on the negative side. I mean, I'm obviously based here in Australia, where nuclear power has been on the nose for quite some time, and even with the forced closure of coal-fired power plants here, there's been no real move to potentially mitigate that with nuclear power. And even some countries like Japan, the Fukushima disaster has obviously left a lasting impression there. And even with the LNG gas shortages they saw there last winter, they're still really, really reluctant to bring a huge amount of nuclear power capacity back online there as well. So I think the conversation needs a little bit more sort of discussion around the benefits of it in the new world order to really become a significant component of the energy transition, and I hope it does, because, as I said, it fits the bill quite nicely for this carbon neutral sort of goals that a lot of countries are striving for. But I wonder if we've potentially missed the boat, at least in the shorter term, considering the long lead times and particularly with all the safety issues now built into the construction of these. That it'll be some time before we see a really strong level of growth come from that market. But I hold out hope that I may be wrong, and we'll see that really turn around soon.
Now, I'll be a little bit controversial here and jump on Daniel's two examples. I mean, obviously, Australia isn't exactly a thought leader in energy transition. When we got a prime minister who can't decide whether he wants to even go to COP26 or not, when we've got a country that's still rattling the saber about coal power, clearly they're missing the boat with respect to renewables and nuclear. And we do have a new prime minister in Japan, Kishida, who has made it part of his platform to restart the nuclear industry. So I think that on a governmental level, it's been a sea change, and this is going to a chorus that continues to grow.
I think that nuclear's got so many good things about it and so many bad things about it too, that trying to work out whether it actually has much of a bigger role to play than it currently does is going to be difficult. A couple of observations. Nuclear requires an extremely skilled labor force. This is not something that's easy for a country that's never done nuclear before to set up. That makes me think that any expansion of the nuclear fleet is likely to be in countries that already have experience in doing it. I can't see nuclear becoming a thing in countries that have never done it before, like Indonesia, Malaysia, Philippines, countries that need energy, need electricity, but I think it's going to be very hard for them to set up nuclear industries. It would require enormous subsidization from one of the existing nuclear powers. So I think within that, you probably got massive nuclear expansion still to come in China. Certainly, they seem to be building quite a lot of reactors and are building more. I think the problem comes, the other big downside of nuclear is it is simply extremely expensive from a capital perspective to build. And often, I mean, tell me when last we actually read a story of a nuclear plant being delivered on budget and on time. It just doesn't happen. The ones that I'm thinking of is Hinkley Point in England, which is massively over budget. It's going to produce England's most expensive electricity under a guaranteed power purchase agreement. I mean, yes, it all goes well. It will be reliable and will be a very useful source of so-called baseload power, but it's very expensive power. And I think anybody who is advocating for nuclear has to work out that this is an expensive source of power, but it has the advantage of being generally very, as far as I'm aware, nuclear is the most reliable form of power from an availability perspective. And it is also pretty good from a carbon perspective, although nuclear plants do require quite a lot of water, I understand. But what you're basically saying is the advantages of nuclear are obvious, but the disadvantages are massive as well. And if you stack up the disadvantages, particularly the cost, it's and the need for a very skilled, experienced workforce, those become quite difficult to see more nuclear plants being built, especially outside of the existing nuclear powers.
Yeah, I certainly agree that the track record, both in the US and in the UK, has not been stellar over the last several decades. But those reactors, we can count on one hand. The 40 that are currently being built in China, 40, seem to be doing pretty well with respect to both timetable and cost. So let's look at where the industry is actually building these things, building them with economies of scale rather than building one every 30 years.
I'm wondering about, I suppose, some other of these kind of alternative or sort of trending topics like hydrogen. And do you have any views on hydrogen's kind of role in this new energy mix? I'll just leave that for anyone to answer.
Well, I'm not going to say a lot about hydrogen. I can't help but quote former U.S. Defense Secretary Donald Rumsfeld. It's the known unknown. It seems to me what's lacking is any real plan on how are we going to use hydrogen. I mean, right now in Australia, we're talking a lot about how we're going to produce hydrogen, and we're somehow going to sell it to, as far as I can see, the plan is we're going to sell it to the Japanese, and they're somehow going to use it. But I'm not really seeing much investment, much talk about how we're going to build up this hydrogen supply chain from making it to actually consuming it and how it's all going to work. So for me, it's still a little bit, I need to see more details before I work out whether this really is the next best thing. To my mind, the world's kind of at the sort of what I might, for those of you who are old like me, describe as the VHS Betamax moment. You've got two things that both really work. You got hydrogen, you got renewables. and we haven't really decided which one is going to be the biggest thing. And, you know, we may not get it right. I mean, the world went with VHS, even though Betamax was a much better system.
Yeah,
I mean, look, you go, Warren.
Sorry, Daniel. I applaud people and corporations that have a tremendous vision, and you need a great vision to foresee a big role in green hydrogen in the world going forward. Obviously, technology, capital, prices have to come down tremendously. You need a huge vision. You know, we as investors and analysts tend to have much smaller minds when it comes to these transformational, longer dated industry developments. And I applaud people who have the vision and the capital to try to solve those problems. It's something that we as individuals maybe leave for those visionaries to work out. And if they actually become practical, then I'm all for it. But that's a real tough one from an individual level perspective.
Yeah, I agree, Warren. It takes a lot for us analysts to really fathom, I suppose, you know, the shift in that technology when it's such an early stage. I mean, for me, the real nirvana will be obviously the green hydrogen side, whether, you know, we can really deliver a truly sort of carbon-free energy source there, and so that's where all the interest, all the real excitement is being generated in the sector, and that's you know, even further away compared to sort of blue hydrogen at the moment. So, you know, there's a fair amount of water to go under the bridge there, and it is really difficult to see how it will play its part. There could be many iterations by the time it actually gets to sort of a commercial stage. So obviously you have to wait and see on this space. But yeah, the potentials are huge.
Okay. I just want to remind our audience that we are taking questions in the last kind of couple of minutes before we wrap up the panel. We've had one coming in looking at thorium and whether that would be suitable to be considered as part of this. If we have any RE experts that can comment on this.
Yeah, I mean, thorium reactors are legitimate, and China is certainly in the process of planning thorium reactors in the future. And so that is a new development. I mean, there is so much R&D going on with respect to, you know, modular reactors, you know, small mobile reactors, thorium reactors. There are all different kinds, and you know, we see the initiative Bill Gates building currently in Montana. So thorium reactors are one of the directions that the future of the nuclear industry is headed, and this is all good. You know, it goes to Clyde's point about making the industry more capital efficient. And less based on individual giant projects, but more in a greater number of smaller projects that are adaptable to certain industrial uses or adaptable to certain industry or country sizes, not just the biggest countries in the world.
And another question coming in is asking, any thoughts on what level oil prices need to get to before world GDP is affected?
Well, I'll have a stab at that. I mean, it's you know, on a pure sort of economic basis, it's still far below where, you know, we'd actually see economic growth impacted. I mean, you know, at the height of the last boom where we saw, you know, 130, 40, $50 a barrel at the time. You know, the impact on economic growth wasn't that huge. So where we are, $85 a barrel at the moment for Brent. We're not expecting to see any sort of economic destruction as a consequence of that. I think it's, if you take in the more broader sort of energy space, then there's clearly potential for that. I mean, we obviously talked about it at the very start, where power shortages, are starting to impact heavy industry, and so that's part of the reason why we saw the weak GDP growth in China in Q3. So, I think if you broaden it to the wider energy space, yes, it's having an impact now, but that's when you're, including gas prices, so LNG prices of $35 per BTU and thermal coal at $2.40, not oil at 90 at the moment. So I think we've got a fair bit to go before we really see that have a significant impact on economic growth.
Okay, and another question's coming in looking at the gold space. If anyone wants to comment on where do we think we're moving from this point?
Sorry, Amy, was that a question on gold?
Yeah, so really just looking at the gold space, and where do you foresee that market moving?
A number of comments there. I mean, there's the gold price, and then there's the gold equities. Gold price has done reasonably well, hanging in there about 1,800. Gold equities are at a 104-week low. Certainly a 52-week low. The gold equities have just been demolished since the big rally in June of last summer. So it's been 1 year of just new low, new low, new low. So I think that's a reflection. Equities are often a leading indicator, frankly, of where the commodity is going. And I think that's an indication that people are suggesting that gold prices are going to go anywhere anytime soon. And I share some of their concern about the gold price. I mean, this is the perfect environment for gold. We've got, continued ratcheting up of geopolitical tensions. We've got a global pandemic that still hasn't run its course. We've got inflation running amok globally. We've got negative interest rates across the world at unprecedented levels. And gold price is down from its highs and not doing anything. So as a gold equity investor, it's easy to see why you're disenchanted, because you're thinking, if gold isn't ripping to new highs in this environment, things can't get any better. They're eventually going to get worse. The pandemic will eventually go away. Real interest rates are going to rise. The headwinds for gold are coming. And so gold better get its act together, or it's just going to head south. And so in that regard, maybe I should be defensive and just sell my gold equities and wait for that correction to come. My answer to that has been, this is probably not a bad time to be buying the gold equities. The gold equities are out of favor. The base metal, the battery material, the lithiums of this world, even iron ore has had its day. Coal price has had its day. Probably not a bad time to be taking all those profits and picking up what's out of favor, which is gold. And you're absolutely right. There are probably headwinds coming on the commodity. And yet gold is so unpredictable. It always does what you don't expect it to do. And so I think gold equities are a great place to be right now, frankly.
In some ways, gold has become like the forgotten commodity. I mean, it was very much in the news last year, and this year it's just sort of meandered around, not really going up, not really going down. And as Warren says, under your traditional gold models, it should be doing really well. I sort of think the gold market changed in the 2000s. And I think a lot of gold analysts tend to be A, gold bugs. They love the metal. And B, they tend to be, like even older and even grayer than me. And they're really using models that worked in the 1990s and haven't really been updated much. I think the big change in the gold space in the last decade or so has been the fact that 50% of the physical market, the physical demand, is basically two countries, China and India. And I never hear any gold analyst ever talk about China and India. It's like they almost don't exist, but you're talking 50% of who actually physically buys the metal. So if demand in those two countries is not looking great, as it currently isn't, then it's very hard to see a rally. Yes, I get the US interest rates, inflation outlook, all those things, they're still very important and are still key. But I think for gold to have sustained rallies, everything has to work in concert. That's what happened when it went up in 2011, is basically you had China and India buying lots and lots of physical gold, and other people across the Western world investing in it as well through ETFs and things like that, coupled with the other third leg of the gold market, central bank buying. So you had all three legs working when it went to its then record high in 2011. At the moment, you have maybe one of those three legs working well. Central bank buying is kind of steady but not great. And then you have sort of a fairly weak situation in China and India, although recent signs of some pickup in demand. But I wouldn't expect gold to rally until at least two or three of those things were working really well together. And as Warren says, I think as you might get India, well, you'll get interest rates rising and that sort of headwind for gold at the same time as India and China demand recovers. And so ultimately these forces may balance each other and gold continues to meander around where it is.
Interesting. So, I mean, we've really kind of covered quite a broad range of commodities, looking first kind of at energy transition, fossil fuels, gold. I want to just ask our panelists if they have any final thoughts to share with our audience before we wrap up for today. Just looking at kind of what do you foresee for the market, I suppose, for the next year, any sort of short-term predictions.
I would just add one more thing. We really didn't talk about it specifically, but, and I think Clyde might have mentioned this, that longer term, excuse me, the supply of lithium, the world isn't challenged longer term with the supply of lithium. But the revolution that's occurred in the demand story for lithium is still, I think, underappreciated in certain corners of the world. I think it's one of the things that Australia does seem to be appreciating. They might be missing the boat on energy, but they're sure getting the picture right on lithium. The number of, the bull market in lithium that's running in lithium isn't quite recognized in North America yet. And I think we're going to see a lot longer bull market in lithium than any of us had anticipated 5 years ago, and then in the recent downturn 2 years ago. It's quite a revolution, and I don't think it's quite recognized globally. Thought I'd just mention that for the viewers.
Great. Daniel, any final thoughts?
Oh, look, for me, I think, the volatility that we're seeing in the market is something we're going to have to get used to. I think the dislocations we're seeing across many markets, I can't see abating anytime soon. I mean, the sheer scale and speed of the transition on the energy side as well is creating huge waves across the entire sort of sector. So it's really hard to see how this thing subsides and we see more stable sort of markets, which is going to be challenging for the industry. I mean, as was sort of touched on in this talk, has been that producers like nice stable prices so they can plan their investments over the longer term. And unfortunately, I can't see that happening over the next 12 months, which in a sense sort of might delay that further wave of capital going into the ground and subsequently widening those deficits or shortages we're seeing driven by supply. So I think that's something we're going to have to look out for over the next 12 months, or even longer.
Okay. And Clyde, any final thoughts before we wrap things up today?
I'll leave you with a very short-term one. Is whenever I see price rallies where the graph sort of goes like that, I know that the next move is down the other side. We saw it with iron ore earlier this year. We're still in the upswings phase of LNG and thermal coal. I can't tell you, nor would I even try to, where the peak will be, but I can tell you that once that peak goes, the fall down the other side is going to be dramatic. And I'm really looking for when that is. As Warren, I think it will go, over the northern winter, but Warren says, the market might anticipate that slightly before. So that for me is going to be, if my job is fun in the title somewhere, that's the fun part, looking for when markets are going to have a big change in direction. So I think that's where I'll leave it.
Okay, definitely lots to kind of keep an eye out for in the next 12 months then. So that kind of brings us to the hour point. So I want to thank our panelists for a really interesting discussion today. And thanks to everyone in the audience for taking part and logging in. If you want to hear the replay, we will have it available in the next couple of days. So yeah, we look forward to seeing everyone again soon at an event, and looking forward to 2022. So thank you everyone today.
Thank you.
Thanks.
Cheers.